How to diversify your investments for maximum financial growth. In the world of investing, diversification is often referred to as the key to managing risk and maximizing potential growth. But what exactly does it mean to diversify your investments, and why is it so important? Whether you're new to investing or have been building your portfolio for a while, diversification is an essential strategy to ensure long-term financial success. In this video, we'll explain exactly what diversification is, how to implement it in your investment strategy, and why it can help you maximize your financial growth. Stay with us until the end for some practical tips on how to get started. 1. What is diversification? At its core, diversification is about spreading your investments across different asset classes to reduce risk. By holding a variety of investments that don't move in the same direction, you're less likely to experience a total loss when one asset class underperforms. The goal is to avoid putting all your financial eggs in one basket, so to speak. Imagine you invest all your money in one stock. If that company goes under or faces a major downturn, your entire portfolio takes a hit. However, if your investments are spread across multiple asset classes, such as stocks, bonds, real estate, and even commodities like gold, you can weather the storm if one area of your portfolio takes a hit, while other investments may still perform well. 2. Why is diversification important? 1. Risk reduction. One of the primary reasons for diversifying is to manage risk. 1. Not all investments move in the same direction at the same time. 1. Some may do well when others are struggling, which smooths out the overall volatility of your portfolio. 1. Diversification helps balance out the ups and downs, leading to more stable returns. 2. Smoother returns. While no investment is entirely risk-free, diversification aims to produce more consistent returns over time. 2. For example, when stocks are down, bonds or real estate investments might be doing well, balancing out the overall performance of your portfolio. 3. Capitalizing on growth in different areas. Diversifying allows you to capitalize on growth opportunities in various sectors of the economy. 3. Some sectors, such as technology, may outperform others, like energy, during certain periods. 3. By spreading your investments across different sectors and asset classes, you increase your chances of benefiting from growth in multiple areas. 4. Protection against market fluctuations. Economic cycles cause different asset classes to perform differently in various stages of the market. 4. For example, during an economic expansion, stocks might rise, while bonds may not provide the same returns. 4. In contrast, during a downturn, stocks may struggle, but bonds could provide more stability. 4. Diversifying helps protect you from market fluctuations. 3. How to diversify your investments. Now that you understand the importance of diversification, let's explore the different ways to build a diversified investment portfolio. Diversification can be achieved through a mix of asset classes, industries, and geographical regions. 1. Diversify across asset classes. The first step in diversifying is spreading your investments across various asset classes. Asset classes are broad categories of investments that tend to react to market conditions in different ways. Here are the most common asset classes. 1. Stocks, equities. Stocks represent ownership in companies and provide opportunities for growth. 1. However, stocks can also be volatile in the short term. 1. Investing in a range of companies across different sectors can help reduce risk. 2. Bonds. Bonds are debt securities where you lend money to an organization or government in exchange for regular interest payments and the return of principal at the end of the bond term. 2. Bonds are generally considered less risky than stocks, and they provide stable, predictable returns. 3. Real estate. Investing in real estate involves purchasing property, either directly or through real estate investment trusts, REITs, to generate income or capital appreciation. 3. Real estate can act as a hedge against inflation and provide diversification benefits outside of traditional stock and bond markets. 2. Diversify across sectors and industries. In addition to diversifying across asset classes, it's important to spread your investments across different sectors and industries within each asset class. For example, within stocks, you might invest in companies across sectors like 1. Technology. e.g., Apple, Microsoft, Google. 2. Healthcare, e.g., Johnson & Johnson, Pfizer. 3. Energy, e.g., ExxonMobil, NextEra Energy. 4. Consumer goods, e.g., Procter & Gamble, Coca-Cola. 5. Financials, e.g., JP Morgan Chase, Wells Fargo. By investing in multiple sectors, you reduce the risk of your entire portfolio being impacted by downturns in one particular industry. For instance, the technology sector may struggle due to regulatory concerns, but healthcare or consumer goods might continue to perform well during the same period. 3. Diversify geographically. Another important aspect of diversification is spreading your investments across different geographic regions. Different countries and regions experience various economic cycles, and some markets perform better than others at different times. 1. Domestic investments. These include investments in your home country, such as U.S. stocks or bonds if you live in the United States. 1. Domestic investments allow you to take advantage of local economic growth. 2. International investments. Investing outside your home country exposes you to global economic growth. 2. International markets, such as those in Europe, Asia, and emerging markets, may present opportunities for higher returns. 2. International diversification helps mitigate the risk of relying solely on the performance of your home country's economy. 4. Consider alternative investments. In addition to traditional asset classes, you might consider alternative investments for even further diversification. Alternative investments are non-traditional assets that don't fit into the typical stock, bond, or real estate categories. Some popular alternative investments include: 1. Private equity. Investing in private companies that aren't publicly traded. 2. Venture capital. Investing in early-stage companies or startups with high growth potential. 3. Hedge funds. Investment funds that use various strategies to generate returns for their investors, often targeting sophisticated or high net worth individuals. While alternative investments can be riskier and less liquid, they may offer higher returns and lower correlation with traditional asset classes. 5. Use index funds and ETFs for easy diversification. If you're looking for a simple and cost-effective way to diversify your investments, consider using index funds and ETFs, exchange-traded funds. These funds allow you to invest in a broad selection of assets within a specific sector, asset class, or geographic region, all in one investment. 1. Index funds. These are mutual funds that track the performance of a specific index, such as the S&P 500. 1. By investing in an index fund, you're automatically buying shares of hundreds of companies within the index. 2. ETFs. Similar to index funds, ETFs track specific indexes or sectors. 2. However, unlike mutual funds, ETFs trade like stocks on the exchange. 2. You can buy and sell ETFs throughout the day, making them more liquid than mutual funds. Both index funds and ETFs are excellent tools for diversifying your portfolio without having to pick individual stocks or bonds. Conclusion: start diversifying for maximum financial growth. Diversification is a powerful strategy that can help you reduce risk and maximize the growth potential of your investments. By spreading your investments across different asset classes, sectors, and geographic regions, you can protect your portfolio from significant losses and increase your chances of enjoying steady, long-term returns. If you're unsure where to begin, start with a simple mix of stocks, bonds, and cash, and gradually incorporate real estate, commodities, and international investments as you become more comfortable. Additionally, using index funds and ETFs can be an easy way to diversify without the need to pick individual assets. Remember, diversification doesn't guarantee profits or protect against losses, but it's one of the best ways to navigate the ups and downs of the market and build a stable financial future. If you found this video helpful, be sure to give it a thumbs up, share it with your friends, and subscribe to our channel for more tips on growing your wealth.